Hello everyone, welcome to today's US live open session, Thursday, February 29th, last day of the month, 10 minutes before Wall Street opens as always. I'm your host Nikos Zavouras, Senior Financial Editorial Writer at FXCM. A data-heavy week as we have said before. The main event today was the US PCE inflation report, which showed moderation, and markets liked it as Wall Street moves higher and the greenback faces pressure. And yesterday we had the the Central Bank of New Zealand keeping rates unchanged and adopting a less hawkish rhetoric. So we'll see how the Kiwi was impacted by that, and there are quite a few more things to cover, such as oil developments, and as always, of course, we're going to talk about the euro dollar and the Nasdaq 100. Before we begin, however, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers carefully, and please bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. And with that said, let's go ahead. We're going to start with the inflation figures from the US. We're going to talk about the euro dollar, then we're going to move into the New Zealand dollar versus the US dollar and talk about the Reserve Bank of New Zealand policy decision. We're going to also talk about US oil, since there are reports that OPEC will extend its production cuts, and that helps prices. And we're going to round things off with the Nasdaq 100 and, of course, its reaction to the PCE inflation figures. So let's get right to it. As you can see on the chart, on the left, you can see the headline PCE inflation, and on the right, the core reading. Now, both dropped, although slightly, to 2.4% and 2.8% respectively, and both are close to 2-year lows. Again, we said it was a bit of a small downtick, but it was enough for markets as Wall Street reacted higher and the US dollar declines, as you can see on this chart. On the left, we have the SPX 500, and on the right, the US dollar, and you can see their reaction on today's data just earlier. And now let's go and talk about how this translates to the euro dollar. The pair continues to show indecision at critical resistance levels due to the murky policy differential, as both central banks are seen cutting in June. That's baseline market expectations. The European Central Bank is more hawkish in terms of rhetoric, but probably a better candidate to pivot due to the weak economy. The Fed has shifted to a conservative approach recently due to robust economy and labor market, so there's no rush to cut, but it has pointed to 3 rate cuts this year. Now, the euro dollar, coming from last week's bounce, tries to move past the pivotal 200 period EMA and the 38.2% Fibonacci, which is this region right here. Which would give it the opportunity to push towards the next resistance, located at around 1.1017. But we are cautious around the ascending prospects, and there is also the daily Chimoku cloud, which can contain any advances. Despite this recent bounce, the pair is in a precarious position as it struggles to move convincingly above this aforementioned pivotal tech region, and as such, and this could send it back to the 2024 lows at 1.0694, but sustained weakness does not look easy, and this indecision could perhaps continue. We struggle to see at this point big moves in either direction, exactly because of this unclear policy differential. Of course, tomorrow we expect preliminary inflation from Eurozone. Inflation has decelerated sharply. That's the over the past several months. That's the CPI headline CPI inflation, and has moved closer to the 2% target, with the last print at 2.8%. Now we expect the preliminary, not the final, the preliminary figures for February. Now let's go to the New Zealand dollar versus the US dollar and discuss a little bit about the Reserve Bank of New Zealand. Of course, if there are any opinions on what we discuss or any questions, feel free to share them with us by typing in the chat box. So the central bank in New Zealand kept rates at 5.5% for fifth straight meeting and toned down the hawkish rhetoric. Policymakers are no longer worried of price pressures, and he moved prior warning that rates would likely need to increase further if such pressure strengthened. Instead, they now believe core inflation has declined and risks to the outlook have become more balanced. Furthermore, they are confident that the current rate, 5.5%, is restricting demand, and they trimmed the terminal OCR forecast to 5.6%, thus lowering chances of further tightening. Now, as a result, the Kiwi slumped. You can see that on the chart, and of course remains under some pressure today. It moved back below the 200 period EMA and is in risk of further pressure toward, and is in risk of new 2024 lows, which are located at around 0.6037, but further losses that would challenge the next support are harder. That the next support seems distant at 0.5858. Now, on the other hand, inflation is still far from the bank's 1 to 3% target, and officials reiterated that interest rates need to stay at a restrictive level for sustained period of time in order to achieve that goal. Moreover, Governor Orr dismissed any cut talk in his press conference, while the updated projections imply that this won't happen until the back half of 2025, more than a year, around a year and a half from now. The Fed, on the other hand, despite its conservative stance, has still pointed to 3 cuts this summer. So, along with oversold conditions or the relative strength index, you can see how it bounces off from oversold conditions. The Kiwi can find support and the opportunity to push for the February highs at 0.6219. But we are cautious around more gains that would lead the pair towards this highlighted resistance area here around starting from 0637. which is this the December 2023 high. So that is pretty much it from the Q as well. And now let's talk about US oil. Of course, once again, if there are any opinions or questions, we'd love to hear them. Now, what goes on in regards to oil prices? They get a lift from reports that OPEC Plus is about to extend its supply cuts into the second quarter, amidst, of course, continued Middle East hostilities that create supply concerns, while today's inflation report from the United States also helps, because inflation moderated further. That means that the central bank of the United States remains on track to remove monetary restraint. Now, the commodity stays above the 200 period EMA and the 38.2% Fibonacci of the last leg down. And there is room for further gains towards 84.90, although fresh impetus would be needed for tackling those levels, and in general we remain cautious. On the other hand, demand is set to slow down this year and outpace supply, according to the National Energy Agency, while yesterday's weekly data from the US showed further build-up in crude inventories. These factors and the inability of the commodity to move away from the 38.2% FIBO, you can see how many times it has tried but rejected, another 1, 2, 3 this year. So there is still risk for a return below the 200 period EMA that's located around a little above the 76 mark. And that could shift bias to the downside. And however, steeper decline towards 71.38 is a bit harder. And similar here, it's hard to see big moves in either direction, exactly because of this supply and demand push and pull. Now it seems to favor a little bit the upside due to concern around supply, but as we have discussed before, low supply has limitations as to how far it can drive prices higher. Demand growth is a much better driver, and this doesn't exist. Demand is expected to decelerate this year. And let's round things off with the Nasdaq 100, FXCM's CFD of the Nasdaq 100. It rises on the PCE report, as we said, and along with renewed AI optimism, it has further road ahead to post new record highs, of course, uncharted territory. On the other hand, the Fed has turned cautious on rate cuts, and the inflation report, yes, was lower on a yearly basis, but month over month, it actually increased. And we still see a risk of renewed pressure and a new breach of the 200 period EMA, which is located at around 17,530. But the downside appears well protected. You can see a thick rising daily Ichimoku cloud, and a significant deterioration in sentiment would be required for any substantial correction. So that's pretty much it from us for today. Looking ahead, mostly we expect Eurozone inflation on Friday, and on Friday and Monday there are also some PMIs coming up from various regions. We will talk again on Tuesday at our usual time slot, 10 minutes before Wall Street opens. Thank you for joining me.